G'day folks, welcome back to another update with high-grade copper consolidating and US crude declining. And just always do some back testing and show you the results of that. Make sure you hit that like and subscribe button to support the channel. Also reference the +1 videos for a deeper dive into some of the trading strategies we discuss in today's video. In terms of the outlook, copper's structural demand tailwinds driven by clean energy, EVs and grid expansion remain intact, but supply constraints, inventory dynamics and China growth uncertainty may temper near-term gains. US crude oil, the balance is tilted toward oversupply risk with high production, inventory builds and soft demand outlooks, though geopolitical or policy events could inject volatility and occasional upside. So looking at US crude first, on the weekly, the price is below the moving averages, and so is the CCI, giving us a bearish momentum. So bearish on the weekly, there's no divergence that I can see there. On the daily, that's also bearish with the CCI below the moving averages, and so is the price. And that's also a bearish divergence. Did a bit of consolidation here before our last video, but that's dropped off. And the last divergence that we had was back here. We had a bullish divergence, higher lows versus a double bottom on the price, and it bounced and hit our target range in that 23-38% range. Now, it actually went a lot further than that, right up to that resistance level at 77.70. That's the daily. Now, looking at the hourly, we also look at the micro charts. And on the hourly, you can see here, working backwards, identifying that we've got a bullish divergence going back to that point from the same period on the CCI. So higher lows on the CCI versus lower lows on the price. Now, this could fall a lot further, which means we have to then just extend it when we do. But assuming it pulls back from here, for those new to the channel, what we do is we draw a Fibonacci range. We take it back to the high, the significant high before that divergence started, and that'd be at that level there. So we expect to retrace at the very minimum to that 23-38% range. And more than 90% of the time, it hits that minimum range, 23-38%. Sometimes it goes right through, other times it just touches it and continues on a downtrend. Now, I don't trade these, I don't go long here. I still go short in the direction of the daily. So if I'm trading on the hourly, I still trade in the direction of the daily. That's the main key to the strategy there. But that's assuming the price bounces from there. And of course, it could go a lot further. And if it does, then we have to readjust the Fibonacci range. Now, on the back test, again, going short from this period around about the 4th of August, you would have gone short there when the price broke below the moving average, and so did the CCI. That's indicated here by the back test. So you can see there's a few average downs we've taken. And the way I read this, I deliberately zoom out here so I can see the moving averages of the price as well as the CCI. And what I'm looking for is these divergence within that 1 hour time period. And I like to mark them so you can see there's a double bottom there on the price versus higher highs on the CCI. And as soon as you start seeing the moving average band bend up on both, that's where you close out your trade. Otherwise, you just let it run, give it time to breathe. And in this case, the strategy shows a few average downs. And following that approach with the bullish divergence, you would have closed out at that point there, which means you would have avoided that drawdown on your account. So same thing, go long when, in this case you're going short, so go short when the moving averages on the CCI and the price are in decline, and close it out when you see both bending up. Again, you would have had a little drawdown there had you continued, but you would have got out there with a small loss with holding a position or two. And so on, taking these short positions and closing out whenever they bend up. So at the moment, if you're going short, you'll see there it had a few little short trades there during that period. But again, what I like to do is one of two things. You can either be a bit risky and follow the price down, but carefully watch it break above the moving averages. But if you want to be really conservative, as soon as you see a bearish, in this case, a bullish divergence, and you're trading short during that period, you would have closed out your positions once you start seeing the price on the moving averages turn up. And so with the CCI, you probably would have closed out your position there and just being conservative and conserve your trading account. So for high-grade copper on the weekly, first off, the price is above the moving average, and it's a fresh breakout on the CCI above the moving average. So start going long from here. If you're trading on the daily, that is, you always go in the direction of the higher time frame. On the daily, we were bearish back here, then we turned bullish, and at the moment you would have been going bullish from that period before our last video. And since our last video on that bearish candle, you would have stopped it out when the CCI on the daily broke into that moving average range. So you would have avoided going long at that point, And at this point, the price is still above the moving average, and so is the CCI, so probably stand clear. Don't go long or short until we see a decisive move on either the price or the CCI break in the same direction. Looking at also for any divergence, and there's none there that I can see. On the 1 hour chart, again, we had a few divergences here through those peaks. And again, that was giving you a bit of warning if you're going long. Now, at the moment, again, you're not trading this, but what we're trying to identify is a trend. You can see there it's consolidating, and on the price as well as the CCI. And when you start seeing the moving average band constrict like it is there at the moment, that gives you a clear warning that it's actually consolidating in price. And that's the reason I use multiple moving averages. What I normally like to see is the moving average band widen as it did back here, and that's give a clear indication to go short. Likewise here, when they start to widen, clear indication to go long. And that's assuming, again, if you're trading on the 1 hour, you go in direction of the daily. Now on the back test, what we've done here on the daily, we would have gone long from that point around about the 28th of August, when both the price and the CCI broke above the moving average. Notice the CCI broke early, but that price is still below the moving average, so you wait for that period. And that's what it's showing you here on the 1 hour chart. Again, going long with both moving averages turning up and closing it out when they start turning down. And as I said, you would have been watching this carefully, had a few warnings here. It's bearish divergence. You could have got out in any one of these so long as it was turning down. And you had the last opportunity there to get out of the trade when both the CCI and the price turned down, and you would have got out there maybe holding one contract with that profitability up there and avoiding that drawdown. For some added benefits, want to subscribe to the Patreon page, links in the description below. This is a few trades we had since early or mid-September, showing the results of those trades. To access the Patreon page, links in the description below. Hit that like and subscribe button, support the channel. Thanks for watching, and see you in our next update.